Hello and welcome to the Monday Call, our wrap up session for 2025. I was going to start with some big, long summary of what we're going to talk about, but I thought we should just crack in and talk about it. But look, it's been a really interesting 2025 for a whole host of reasons. And I think most of our listeners can probably guess, but we started with the inauguration of Trump and volatility with Liberation Day. We've had volatility in a number of different sectors, be it crypto or AI shares. We've had some amazing performance results from some alternative assets like gold and silver and copper. And we've also finally, perhaps, touch wood, seeing some green shoots in the New Zealand share market. So without further ado, shall we get into it? We've got our Chief Client Officer, Stefan, that everybody knows, our CIO, Mark, who everybody should also know.
Morning, everyone.
And I think we're just going to do around the traps of the investment markets and talk about it. Do you want to give us a bit of a synopsis of maybe some of those numbers to kick off with and go from there? Is that a good place to start?
Yeah, that makes sense. Look, I think if I sort of think about what's worked and what hasn't, probably starting point is markets have worked. Yeah, they've had a lot thrown at them this year, but returns on the whole have been excellent this year. And if you look at across sort of global equity markets, generally they're actually, with the exception of New Zealand, which we'll come to, generally global equity markets have enjoyed sort of mid-teens or better type returns. US is up sort of at this point, sort of 16, 17 odd percent. And, you go to a place like Asia and they're up sort of 20% plus. So, in that sense, share markets especially have worked really well this year. And, the nice thing is, in terms of our growth portfolios, we've had a view coming into the year. I think that the year was going to be bumpy. We've certainly seen some bumps, but the year would end up being a positive one. And we've got what I suppose 3 weeks to go, so never say never. But it's likely that it will end up being a positive one, and the portfolios definitely have enjoyed that positivity, which is great.
So when we jump into some of the details around some of those different drivers, and we've talked about certain themes that are perhaps coming, you know, I guess coming to the fore throughout the year, and the big one I think on everybody's mind, and so I thought we should just talk about that one first is AI.
Mhm.
And the if I had a dollar for every time I read a headline saying bubble, including from places like The Economist, so it's not just rag media; it's
Yeah.
really sophisticated media. If well, I assume The Economist is talking about it, but it's easy to say bubble and not really understand actually what's driving it, what's going on. And AI is not just a couple of companies; it's an entire change in the way that we, I guess, deal with and work with technology. Can we can we perhaps talk about what has been the driver in terms of what's happened to the tech companies, and then how we see things going forward? I've got a few little bits and pieces I want to talk about as well, which I found interesting that I'm copying off other people who have talked about it over the past few weeks.
Sure. I might take a little bit of a tangent on that question first, though, is that, I think if we sort of compare and contrast, go back maybe to uh, not so much this time last year, 2 years ago, sort of late 23. At that point, it was very much the Magnificent Seven. And if you owned those seven stocks, you had good returns. Otherwise, things were pretty blah. Uh, this year,
Blah is a finance term, right?
yeah, that's the
Just
technical
important to
term.
clarify
Yeah.
these things.
Uh, yeah, you had to own those seven stocks. Otherwise, you didn't have return. Uh, Come forward to this year, and what's been very interesting and quite pleasing is, and actually probably it's your first, I suppose, the first point against AI being a bubble is actually we've had broad returns across regions and actually across different types of shares. You look at, say, within our portfolios, we have the inflation space, which is there as a more defensive share sectors. You look at utilities and infrastructure. So, sorry, three sectors: utilities, infrastructure, and property. Property this year has struggled, but infrastructure and utilities, both domestically and globally, have performed very strongly. So again, low double digit numbers. So from that point, you've had a much, despite all the focus and a lot of the media attention on AI, definitely had broad performance out of other types of shares. And I think a lot of that has to do with expectation, right? Is that, yeah, AI is working, it's being rewarded, but equally expectations coming into all of this have been very high, whereas expectations elsewhere are much, much lower. And, ultimately, share prices are an aggregate of expectations. So if expectations are being beaten, are improving, share prices should move higher. If expectations are being met, yeah, they might move higher, but probably not to the same degree. And I think you're seeing that in AI. You've got some fantastic numbers coming out, but yeah, a lot of that's already in price. And yeah, that's not to say that the tech space hasn't performed well. Certainly, it's been a bit of a game of two halves. It had a pretty slow run in probably to the tariff announcement in April, but since then it's been very strong and really outperformed the rest of the market. And, from that point of view, bubble, yeah, certainly there are parts of the market where I think exuberance is probably the right word. We were on a call recently, whereas I think was it OpenAI is their data center needs in the US are going to use what was it 25%, I think, or was it more of the electricians in America? I think that was the number, wasn't it?
I if you are wondering what to do at university
Yeah,
next year, don't go to university, train as an electrician because you're in high demand.
correct. Yeah. Um, and but equally, the example I've used a number of times is if you look at somebody like Nvidia, and maybe that's the sort of the picks and shovels of AI. Maybe it's not the frothy space, but you go back 2 years ago, they were earning 18 billion in Q3. They've just reported 56 billion in Q3. So from that point, earnings are three times higher than what they were 2 years ago. Margins have increased. And if you look at cash flow, it's more than four times higher. It's gone from 7 billion to more than 28 billion.
So that's another way of saying that I guess the share prices of a few years ago um, broadly, correctly priced in expected growth,
Yeah,
and the growth's manifested, and it justifies having the high multiples that it's had. I guess the question that everyone's asking now is like, can it continue?
correct. And that's the unknown, right? But from our point of view, you look around the way in which AI has been used and the amount we use it. Uh, I don't think that we're in a bubble at this point. I think very much the question that so many people are asking, are we in a bubble, is in itself a sign that there is uh, wariness and some concern out there. And that's actually a good thing because people will be taking actions on that and they will be reducing positions, which becomes a self calibrating factor. It's when people are not concerned, it's when they're going, this time it's different that we are.
Yeah, the fact that we're talking about it rationally means by definition it might not be a bubble. If I compare the one that I compare it to, and this is probably a horrible analogy, but I know because I participated as a Auckland housing auction in 2021, there was no thought that this will stop, that the price rises will continue. And you had to buy no matter what, no matter the price, no matter the multiple of income, the debt levels, etc. And that euphoria of I must enter this market
I'm
or
going to miss out.
I'm going to miss out is. But whereas Nvidia had their result a few weeks ago and actually traded down slightly because expectations weren't quite met on some metrics. I mean, it was a pretty unbelievably awesome result, but that's a rational market, not a euphoric market.
Yeah. Yeah. I think certainly there are areas where, and certainly some of the power needs and some of the build expansion that is happening is it it's hard to see that all happening and all being achieved in the timeframes they want. So from that point, in fact, in some ways, that maybe that just says that supply is not going to be there to the same degree that people that demand may need. So actually, you do get some price tension, and from that point, that might actually be positive for some prices.
I think the estimates is this year 600 billion US has been spent on data centers, and that's going to happen again next year. And that's US, so it's 1.2 trillion New Zealand compared to sort of our GDP.
It's quite hard to. I find it really hard to conceptualize those sorts of numbers
Yeah.
because it's I guess a trillion is 12 zeros, so that is a lot of zeros. Um, but equally, Nvidia's what 6 billion, 7 billion Kiwi trillion dollar Kiwi company in Kiwi dollars, and Microsoft, who's also spending, is a $5 trillion company, and it's spread across all the major players plus many others. So when I ask myself, is this um, completely out of step or out of sync with capital expenditure generally against the context of, or in the context of companies that are just so big, it's hard to conceptualize whether in fact it is that much. I mean, it is a lot, but
Yeah.
do you know what I mean? It's
And yeah, it's hard assets as well. But it's not like 2000 where all this money was being spent on kind of nothing or no revenue at least. But this money is being spent, whether they get a return on investment, or the proof will be in 5, 10 years' time to see if some of the spending is obsolete. But they are spending it on stuff like physical land and data centers and copper and cooling things and things. It's hard assets that though.
So and we forget in some of those numbers, and again, Nvidia's probably not the best example in this, but yeah, their free cash flow for Q3 was about $30 billion. That means give or take, they're a run rate of about $100 billion of a year of money to spend, that the cash they've got after they've spent for their normal um, operations and normal capital expenditure needs. So
a lot of the same criticisms were made of Facebook at the time when it IPO'd, and there was a sort of a 3 to 5 year runway to profitability. And people, there's no way that it can justify this kind of price at IPO, let alone the attention that it gets. And then roll forward a few years, and they've commercialized it, as I expect many of the AI companies will. And suddenly it's producing inordinate amounts of cash. Right? There was a period in 2021 or what have you when they couldn't find ways to spend it, basically. So I guess it comes down to it doesn't fit naturally with people thinking the nearer term. But if you're building infrastructure like this or technology and investing in that way, the run in is longer
and
commercially and I guess sort of from a production
And
perspective.
and I think you need to go take a step back and yeah, all of the discussions from those at the Nvidias, Microsofts, the Amazons, etc., is that there is more demand than what they can meet. So, and in many respects, we are still at a very early stage. Yeah, this is probably 2G in a cell phone type analogy. Yeah, in fact, the phone is probably still connected to the car from an AI
It
standpoint.
wasn't even 2G, wasn't it like XTE or something that Spark used? Or was it like some weird technology that they soon
Revolutionary.
yeah.
Exactly. So I think yeah, people forget and think that AI might actually be quite a, yeah a long way down the path, whereas in actual fact, this is very early stages. So
AI is not the only area in the market that's been, I guess, where there's been a bit of a supply demand question. Gold.
yeah,
Tell us about gold. What's happened there this year?
yeah. Well, I think and it becomes an interesting segue. Last year, yeah, your top performing assets were Bitcoin, and I think gold was pretty close there. This year, Bitcoin and yeah, probably was up there until recently. Now is slightly down for the year, so that's not in the top performing group. But certainly, gold and silver um, are yeah more than 50% up this year. And why? Yeah, ultimately, it is we always think about commodities in a demand supply framework, and we know that gold, there is some supply in gold, but um, from that point of view, it's very much um, that supply is very fixed, but demand is changing, and it's coming from a number of different ways. One, the big one, which we've talked about a lot, is really that. um, central bank demand, coming out of the war, I suppose, with the start of the Ukraine war, very much a case that central banks around the world became really, I suppose, ultimately concerned that they were holding or exposed to the US banking system and they wanted ways to hold their reserves, uh, or diversify their reserve holdings. And from that point of view, that means that they're buying about a third of all gold produced, and that has been going on for a couple of years. It continues this year. I think with the moves up in gold price, uh, and generally with interest rates coming down, yeah, professional investors like ourselves, yeah, and even I suppose individual buyers tend to buy gold if interest rates have fallen. And you've seen some really large moves in the ETF ownership, and that has so you've had a much longer answer than probably than what you wanted, but you've had you've had more buying from central banks, more buying from institutional investors and retail investors through ETFs, the GLD ETF, and fixed supply. So in that situation, price has to move up, and it has a lot. Probably got a little extreme in October, where I think it was up about 20% in 3 weeks. Came back relatively quickly, but we don't see much, and it's probably a segue. Looking forward to next year, we don't see a lot that actually changes. That you still got this uh, the demand situation that is there, supply is fixed, and if anything, in an environment where probably the US dollar might be weaker, assets like gold, silver, even copper or oil that are priced in dollars, there's probably some upward pressure on prices.
I think when you think about the actual logistics of it as well, even if most of these professional investors, we'll call ourselves, are buying it using financial security, say an ETF, uh, those ETFs have to then go and actually uplift the physical gold to back that buying. And so while there is a supply restriction, you think, well, this gold that financial institutions using isn't actually being used, or is actually being used in the sense of it's needed to be stored and backed. And so there is I think a few months ago, there were some articles in the Wall Street Journal about planes being filled with gold, uh, being flown from Europe to the US for these ETFs because so much was going in. So you're actually seeing financially it happening, but also physically the gold is moving and being stored and used when all these financial players are buying it.
Yeah, and clearly that's even more extreme in silver. That is an asset which sits somewhere between a precious and a base commodity, so sort of somewhere halfway between probably copper and gold. And that is an area where it's not one that we have exposure to, but where the supply constraints are really material. And that's what's driving some of that
Silver
price action.
hit it's just crossed its 50-year high, I believe. It was in the late 70s or something when it was at these levels. Yeah, yeah.
Which
Again,
again,
long wait for the people who bought it that way.
yes, which again, interesting was a point where it had a massive sup- supply imbalance where you just couldn't get your hands on it at that point.
Yeah, silver's an interesting one. It's like you're saying, it's one of the big components used in solar power, which is booming in terms of usage, but it's a volatile uh, experience compared to say gold, and hence why in the portfolios, we've had silver before, but it has to be at very small amounts because of the volatility, and gold's just a much more stable type of investment.
Do you think that the cultural piece, and there are certain pockets of the world, India, China, where gold is uh, held sort of at a retail level and with significant sort of interest. Do you think that's going to continue in the same way, or has it reached its?
Look, I think it's always there, and actually there was an interesting article locally that if you look at jewelry, traditionally jewelry has been a bit of a balancing item in the gold demand supply. When prices move up, often jewelry demand falls away, and when actually the supply comes back, people start selling it, and when the price drops, you see jewelry demand increase. Some local comments suggest that, say the Indian community, which has been large buyers of jewelry, is actually buying bars and coins now because uh, you get more gold there versus jewelry where there's a markup, there's design costs, etc. So in that sense, maybe that's that. traditional pattern happening again, where actual true jewelry demand's falling away a bit, but actually it's being replaced by people looking to buy coins and direct bars.
I saw a personal anecdote, um, and I'm not sure that the Auckland gold buying community will move the price much, but I guess the sign of the times as I was walking this morning, there was a billboard that said, sick of leasing your property, gold is a lot less stressful, something to that effect. And so, people are, pushing it, I guess, as a
Maybe that is
investment
muddled.
proposition. Mainly that's a bit.
Look, I think coming back to the key point though is, yeah, from the point of central bank buying, there has been a decent amount of central bank buying, but if you've got, just put it in their shoes and comes back to that discussion about size again. If you've got of your reserves and yeah, there'll be plenty of countries around the world where gold might be 3% of their reserves and they want to get it to 10. That's not a 1 month, 2 month, 3 month discussion. That's a 2 to 3 to 5 year program because, it means you are buying a couple of $1 billion of gold, probably physically, and that takes time.
I think before I segue into crypto, which is a great segue from gold, I think a reminder that one of the biggest attributes of gold is that, and we've talked about it on this podcast a lot, and with all the client reviews that all three of us have been going through with our 6 monthly reviews with our NZ funds clients, is just the low correlation or no correlation between gold and equity markets. And so gold moves to the beat of its own drum with all the drivers that you've been talking about. And it can be a nice additional uh, driver of returns over and above what we're doing in the share market, and that's a portfolio manager's nirvana because it's not really increasing the risk all too much because of the low correlations.
Yeah, yeah. We ultimately the portfolios are built for shares to be the primary driver, but it is good to have diversifiers there that can both add return and change the path of returns through different periods of times.
So on crypto, Bitcoin is much the same as gold in the sense of that's what the market sees it as, but it is still a relatively new asset class and so has its volatility. What are your thoughts around the journey that it's gone through this year?
Yeah, well, I think it's been it has been an interesting year. Um, interesting you touch on volatility. So, probably go back 3 months at that point, we'd had a very low volatility point. So, and people do point to it as being volatile and has historically. But, for the period sort of for much of, say, probably April through to October, you had volatility actually sort of getting down towards 30% per annum. Now, that's the same as most New Zealand single stocks. So that's no more volatile than a single New
In
Zealand.
Fisher& Paykel Healthcare or something?
Yeah, very much so. So, I think people need to be a little careful when they say it's really volatile. It has been more volatile now, and it's actually come down from sort of highs of 120 to sort of the mid 80,000 level. I think one thing that is interesting, and we probably are seeing, we've talked a lot, we view it the same way. It's about demand and supply. But one thing that may be happening, and saw a really interesting article recently that somebody talked about the concept of um, Bitcoin going through a silent IPO. And yeah, you touched Stefan on Facebook, Meta, and we look at a number of those sorts of technology companies, and Facebook's a great example. Uh, Goes from nothing to this really large business, lists, does okay, but actually then after a listing has a period of what was it, probably a year, year and a half, where it was quite a decent way below its IPO price as people discuss could it make money, etc. Um,
And founders got out, or not founders, but initial share.
and that's the key point is you often have with these liquidity events, with the IPOs, this transition of ownership from those who've been in since early days, made an awful lot of money, and you know probably have a slightly different risk appetite, are looking to diversify out of that sort of large holdings. So you naturally get a larger number of sellers. Has it been negative for Facebook over the medium term? No. Price now is way, way multiples of where it listed. You may be seeing the same in Bitcoin where you're seeing um, maybe at these levels, holders have been there for a long time and since, 1,000, 2,000, 10,000, whatever the number, choosing to diversify out and actually having that transition from early stage investors to, again, sort of probably more longer term institutional style investors who are buying now and able to buy now for that sort of second phase of the asset and that phase of its maturity. So yeah, we wouldn't be surprised to see it be at these levels for some time, but ultimately we do think it's got a lot of potential given that demand and supply and the new uh, institutional investors coming in. That it is still a small market. You get a small allocation from institutional investors that dramatically changes your demand supply dynamic in a positive way.
Everything's kind of gone right for Bitcoin over the last few years, hasn't it? Or other digital assets too, notwithstanding price volatility. But in terms of its maturity as an asset class, institutionalization is a big word, regulatory piece, acceptance in parts of the world, new providers offering access and, larger organizations custody and making it available. It's moved so far along from where it was.
Well, even if you just think about yeah the the BlackRock ETF, that's now 90 billion. I haven't checked the last month or so, but yeah, 80 to 90 billion dollar fund from zero at the beginning of last year.
And that's just one of them, right?
Yeah.
Did you know if you put $10,000 in Amazon at its IPO in 97, it would be worth 35 million now. And it had 7 or 8 50% drawdowns and a 90% drawdown in 2000 in the tech crash. And only one person stayed the course, and that was Jeff Bezos, and the rest is history there. But that transition, especially in some of those 50% drawdowns and things like that, were, this is a bubble and those sorts of things, and it's too highly valued, and all it does is sell books and those sorts of things. Where this new piece of technology called cloud was coming to the fore, and it really participated in that. I guess the point is that uh, Amazon was going through a transition, exactly what you said with Facebook or Meta, with a change in ownership. Some of these people who were invested in Facebook pre the IPO would have done very well, thanks very
Made
much.
made their 50 times money or whatever
Yes,
the 100 times. Yeah.
but the patience of having, if you had 2 or 3% of the portfolio in Amazon from '97 and didn't touch it, it would be your best performing
Yep.
stock in your portfolio by a country mile.
And I think there's a couple of interesting points about that. One, yeah, even if we are in an AI bubble, a lot of if you were convinced that the internet was a bubble in 98, 99, you were right. The risk is that you didn't reinvest in 2002 or 2003 and potentially were underweight tech for a very long period of time. So really missed out on what was a fundamental change in the way life and markets were working and where returns were. And that is a real risk if people are choosing to stay away from AI now as they
And crypto
yeah,
assets
yeah, very
around,
much so.
and it's not just Bitcoin. We also do a lot of research around some of these other layer two types of platforms, because that's going to be the technology that takes some of these, I guess, day-to-day things we do, like currency exchange, forward over the years. And you can't sit on the sidelines and say it's never going to take off, or people are always going to go to a bookshop, aren't they? and s- and and actually participating in it and researching it and being curious, but can go a long way to make sure you stay up with that technological.
And the other one, of course, is the relative size of those markets. And yeah, you touched on Stefan, sort of the size of Nvidia and Microsoft, etc. Bitcoin, yeah, is a circa 1.6, $1.7 trillion market. Yeah, it's smaller than a number of those individual US technology companies. Compare that to gold, which is around about sort of 28 to 30 trillion. Yeah, it's still a fifth. Well, it's that, yeah, 5% of the size, basically. So, from that point of view, uh, it doesn't take a lot of extra demand to start to grow that market.
Should we talk about a market that's even smaller and go to a $200 billion market? and talk about New Zealand. And uh, Stefan was did a lot of work over the weekend because he's got this great timeline of what the RBNZ has done this year. And when I look at that, all I think of is just if all of that was done just a bit earlier in the year, we might have had.
There's one mistake you've made, is that AI did most of this work.
It's
So
brilliant.
much of my weekend wasn't doing it, but it is all really interesting when you map it out
Yeah,
over the course of the year. And I guess the key thing is that things have changed quite a lot from the start of the year to the end of the year in New Zealand, but prices haven't moved that much. Do you want to take us through, how you see it, Mark?
Yeah, look, I think again, sort of that opening comment of what's worked and what hasn't. Coming into the year, one expectation that we had was we would see uh, a decent rebound in New Zealand, and actually, we thought New Zealand stocks were well placed. Uh, Clearly, we're wrong. When I look at sort of the New Zealand share market at basically up 3% or just under for the year, yeah, that has been a disappointment. I think it's actually, I think positively, I'll take some silver lining, is that's the one of the real opportunities for next year. Portfolios have performed well this year, but actually we expect New Zealand to start doing some heavy lifting next year. And I think, yeah, coming into the year, uh, the RBNZ certainly was cutting interest rates all of last year. In fact, if we forget, they started, I think, in August 23, cutting rates actually, or stopped raising them at least. I'll need to check those numbers, but yeah, they've been cutting rates for some time, and I had expected that we'd see that and the combination of some strong agricultural numbers coming through to actually start to lift the economy. I think what ultimately was missed is certainly in the urban New Zealand, from an economic standpoint, lack of confidence. And even though people probably had at the margin a little more money in their back pocket, through the interest rates that we'd had, is house prices being down and just general cost of living meant that people were not willing to go out and spend because they were concerned about their wealth and the amount of money they had. And ultimately, that's taken much more in the way of interest rate cuts to start to change that confidence. But I think you look around different businesses. We're seeing economically, you're seeing starting to see those green shoots come through. A number of them, construction numbers, consents, house price sales, things like that are starting to be more positive. And I think the bit that people may miss is that because this has been quite a long, um, yeah, recession or long slowdown, is people forget how lean many businesses are. Yeah, they haven't replaced staff; they've made do with what they've had. And if you get a little bit of revenue growth at the top line, I think again, think of those demand supply pressures. Businesses will find quite quickly that they need more staff. Uh, they need to expand to meet demand, and also it means that any of that sort of extra revenue will actually come through as profit pretty quickly.
I think when I look at this timeline, I agree with everything you've said, and but I think that RBNZ has some culpability with confidence because they cut 50 basis points in February. Then April happened, which was Liberation Day. I think there was just a lack of confidence, and we readily, despite us as investment uh, into the listed market was concerned, I think we saw that as an opportunity.
Yep.
But I think that that sort of blew some confidence in the wider economy on a market that was already feeling economy that was already feeling a bit under pressure, being New Zealand. But then in May they did do a cut, but only 25 basis points. Then they held in July, and at this point, businesses were screaming out, "You, we are really struggling here." And then we had that capitulation, that negative 0.9% GDP number, which, yes, it was backward looking, but it sort of proved that earlier in the year things were tough. And I think that was as an investor into the share market, that was absolutely what we wanted to see because that is the signal to buy because things were, the RBNZ had capitulated, they were now cutting aggressively. The economy was really, really at its low point. And that number could have been slightly overstated. Maybe it wasn't as negative as it was showing, but it was it felt for a bit there in August, September that, well, things are super tough. Yep. But at the same time, uh, companies were starting to see on the go look forward basis, actually, things were a little bit better. So when I think about get to the point, James, when I was thinking about the 3% New Zealand share market number you gave, what's really interesting when you dig into that is something like Ryman Healthcare is down 30% year to date. That is tough, but it's up 30% for the last 6 months.
Correct.
And so, yes, it's still down. It's got a long way to go and a lot of wood to chop, which is great because we own it and we've got see a lot of upside. But that last 6 months when everybody kind of capitulated has actually been really positive. Rome's gone from down, I can't do the exact maths,
Down 50.
down
Yep.
50 or something to now down 30. That's a and then you look across some of these other companies, that theme is rings true across a number of different companies in the NZX. So if you look at the 6 months numbers versus the year to date, we're starting to see it move, and that is great evidence that one, uh, moving into the New Zealand market that you and the team did is a good decision, and two, but there's a lot more to go,
Yep.
and all of it's tax free.
Exactly. We can come to that point in a minute. But I think, again, sort of coming back to sort of first principles, yeah, if we look at, we know that shares over the long term will, yeah, provide a 8 to 10% return, depending on inflation. And over that time frame, yeah, that doesn't really matter what market you own. If we look at New Zealand, New Zealand had a period in the teens, 2000 and sort of 10 onwards, where it was over earning. It was doing 15% per annum year in, year out. The last 5 years, 2% per annum. So, yeah, New Zealand market's been dramatically under earning. Why? Because the economy's been slow. But
And don't forget inflation, and that's in nominal terms, right? So, after inflation, you're actually going backwards in real terms.
correct. Yep. So it has some real catch up to play. And I think it's well placed to do that in an environment where you have an economy with a low currency, low interest rates, and yeah, it's ultimately pent up demand domestically, I think, situation.
It feels like cyclicals are the ones where the action is in the last wee while. Fletcher Buildings had a better run more recently.
Well, again, we've talked about before, work we've done in terms of looking at the cycle. It's the period where New Zealand shares typically have their strongest return is after the interest rate cut cycle has finished, and it's when you're on that low point where interest rates are low and the economy is beginning to grow, and that's when cyclicals, other types of economically sensitive names really start to perform.
Stefan, when your team of advisors are out there talking to clients who are mostly, well, not mostly, but a good proportion of business owners, are you starting to see them talk more positively about their own business and situation? Because they've got great positive performance from their portfolio, but what about the underlying businesses? What's the
Yeah, I think they are. I think Survive to 25 was last year the thing, and then it became Survive through 25, which for the most part, I think the businesses and the accountants and that I've had the pleasure of speaking with and my advisors too, it does feel like we're turning a corner, and I I think consumers need to rebuild their personal balance sheets, which will be happening as rates come down more and more, and that will translate, and everyone's expecting that to translate to more revenue, and then for the most part, businesses have taken a lot of cost out, so it will quickly move to higher earnings. And so, yeah, I think that going into next year, it's definitely a better place than we were a year or 2 years ago.
yeah, I think it's just one of those things that period was it 2015 to 2020, the rock star economy. I think we weren't used to going through economic cycles, and we are in an economic cycle, and it's not unheard of.
Yeah.
This just happens.
And you kind of acclimatize yourself to success in a way. I don't think. I mean, we were all working in financial markets at the time, and it was hard to looking back, thinking 14% or 15% for close to a decade is wow, that is amazing. But I
It,
guess you
it,
get
al-
Which is what you're
acclimatized.
getting out of US shares at the moment. So, like one of the comments that is very interesting, and we've talked about it before, is throughout that period when New Zealand was doing so well, a number of clients said, "Well, why do you own any international assets?"
I was going to say exactly the same thing.
Now we're getting the reverse, right?
And things go in cycles.
Yeah,
Yeah.
geographically diversified, no matter what
Yeah.
is going on.
I guess from a client's perspective and for clients and advisors listening, it's important to realize when we talk enthusiastically about, say, the American share market, it only forms a portion, an important portion of a diversified portfolio. And the goal is to, over time, deliver, depending on your personal risk allocation and circumstances and spending requirements, they're 8 to 10% from the share markets through time. And if you've got an allocation to bonds or cash or other defensive assets, it will be different again. So, which probably is a good segue to how has the bond market broadly performed over the last year? Given that's an important part of many people's portfolios.
It is. Yeah, I think that's been probably a game of two halves. Certainly the New Zealand side, Australasian side, with New Zealand cutting rates as we have has been positive. That's returned sort of a 5% number. So in an environment where the OCR has got a two on the front now and it's a low two, uh, difficult to expect that next year, definitely. Uh, Globally, the challenge interest rates haven't come down as much, and especially in the US. And that'll be that's a very interesting theme for next year. I think we can talk about the potential replacement for at the Fed chairman. So Jerome Powell finishes his term in May, so there will be a change there. And this year, basically, US interest rates have remained pretty elevated in that sort of high threes, 4% type region, depending on where you are on the curve. And that's muted a lot of returns in that space generally. But as we go forward, it's probably if we sort of start talking about next year, that's really one of the factors that might make next year lumpy is the new Fed chairman. If you have somebody, and it's likely you'll have um, a chairman who will be more growth orientated, more willing to cut rates. And, in the short term, that's really, especially if you own short rates, that's good for the bond portfolios. It's good for share portfolios and lower interest rates are good, but it's a question of how low they go and whether the share market starts to say, well, actually, we think we're going to get too much growth, we're going to get inflation. Shares may have an issue on that. Don't know if you have a view, James.
I think it's just one of those transitions that the market will be obsessed with for a little bit as they get used to. It's all the communication and the press conferences and the little words that those people say within their speeches and things. But yeah,
That's what does make it interesting is, if it is, the suggestion is that the front runner is Kevin Hassett at the moment. He is more likely to, in those speeches, even if the Fed as a committee is not as aggressively focused on lower rates, he's more likely in those discussions to be, we're going to have lower rates.
yeah, he does
Cloning.
he does have half an hour between the release of the marks or what do they call it? There? The
Yeah,
monetary policy statement equivalent in the US, and when he speaks, and he will be watching markets and he will drive down those expectations of
I
interest
think
rates.
so. Yeah.
I think overall, if I'm when I really think about it, and when I really think about NZ funds being an active manager, in those situations of a little bit of not upheaval, but uncertainty around changes in Fed chair and things, I think the important thing is that we always go back to first principles around valuation, earnings, those sorts of things that drive an underlying company, because at the end of the day, that's what we're investing in. From a bond perspective, I think that when we look at the New Zealand bonds, uh, it's a really stable, liquid market in New Zealand with lower yields because interest rates are down, but still a nice way to provide defensiveness in the portfolio. And the global bonds, I think that as people need to come out of cash because they're getting nothing there, they've got to go somewhere if they still need defensive assets. So I think it's just one of those things that you can't get too wrapped up in the day to day, albeit that, with the lumpiness, it provides opportunity to invest some good assets.
Yeah, and then coming back to one of your points earlier about shares and especially domestic shares being tax free, I think with low interest rates, especially here, I think it probably is certainly, we see this with advisors. It's very much their role to remind people as to what's their horizon. Yes, they need capital for spending needs and shorter term needs, which cash and bonds can um, and do provide. Uh, but it's not certainly not the time to be reaching for yield in those income areas. Your real opportunity is to, if you've got the right horizon, which is the key question, is to actually look at New Zealand shares, look at defensive shares that provide that tax-free return and I mean, potentially a real opportunity over that sort of 5 to 7 year time frame to materially outperform cash and maybe even bond investments, certainly on an after-tax basis.
I think it's these periods where, look, if we've always said that there's multiple ways to generate wealth, and owning a house is really positive. Having a diversified portfolio of shares, all those things are great. And periods like this, though, is when you start getting a little bit of lean in from yield chasers to things that we would never want,
Yeah.
even consider. Mezzanine financing of property developments when you're not an expert. There's some people that make great returns out of that, but that's their day-to-day job. But the headline interest rate in the Koru magazine on Air New Zealand looks juicy at 9.5% when you're getting 2% at the bank. But there's a reason for that, and it's this period where we just have to be really, really careful about what's the underlying asset backing, and it might not even be an asset backed. And this private credit market,
Yeah.
um, is starting to really, I don't want to say bubble, but it's starting to be quite a big part of the market, especially in Australia. We've done a lot of work around that Aussie private credit market, and I think that the the yield assets in the portfolio are there for stabilization and yield when interest rates are high, and yield when interest rates are high are good because shares don't do as well in a high interest rate environment. But in a low interest rate environment, if you want to have a better return, you need to talk to your advisor about your asset allocation and have more shares if that's appropriate, not go and invest in a some sort of mezzanine property syndication, whatever they're called, at 10%.
You pay for what you get what you pay for, and you pay for what you get, right?
And we're starting to see some of those start to creak now in the market right now in New Zealand. And people, they may or may not get their money back, but they're certainly locked up for
For a
quite
period
some
of time.
time. And you've gone from uh, uncertain liquidity to no liquidity.
Okay, that's the year I guess, in review. Crystal ball gazing, shall we? What what do you think 2026 has in store for us, mate?
And look, I think the things we haven't touched on yet are um, US midterm elections next year. So, excuse me, by definition, that probably produces some noise and some volatility. But, I think, again, if we step back and sort of first principles, as James said, if we look around markets, foundations are good and solid. And we do see earnings coming through. We've got AI that is dramatically driving earnings for many companies. You go elsewhere in the world, places like Europe, actually growth is likely probably to be better than people expect. So expectations are quite low. So we do see that, the foundations for many share markets are very positive and we'd expect positive returns at this point. I think but equally probably like our view coming into this year, a lumpy year. Discussion about sort of US interest rates has some potential for markets to get concerned at times. I think the other one that probably comes out of that, if US does cut rates materially, you'll see the US dollar weaker, which is good for commodities, probably good for the New Zealand dollar. So New Zealand dollar stronger, um, and clearly domestic shares we think are really well placed. What have I missed there?
I think it's the importance of going into a year like next year where we're actually really positive is just to remain uh, what we've talked about all year, but also all podcasts, remain diversified across geographic diversification and asset class.
Yeah.
And what we do as the investment manager, what Mark and the team does, is lean into some of those tilts where we see some real value, like what you just described, New Zealand, China, those sorts of markets. Some of those commodities look really interesting. So I think it's kind of business as
More
usual.
of the same.
Yeah.
Yeah.
It's interesting, right? At the start of the year when Trump was likely to come into power in the very near future and geopolitics were so front and center of everyone's mind, and in turn pricing of assets and market dynamics. In the end, what matters is something different. Are the businesses that you hold delivering real value to society, and are they growing? Are they creating new products and services that people want? And do you have a portfolio that's properly diversified? And have you got tilts that are you're trying to exploit opportunities in the market? It's not whether a tariff's going to be 35 or 45%, and because I guess those businesses are really adaptable and they come up with new ways to resolve their problems and move forward.
Like it's just such a good point, Stefan, because we've got a group of summer interns in at the moment, all 10 times smarter than any of us. So soon we'll be working for them. And what's amazing is they did some analysis last week that if the rideshare industry even has 20% of their car fleet in autonomous vehicles, the return on those shares will be sort of 10 times or something like that. And we're actually going to get them to present over the summer around some of their findings. But that's exciting. And none of that cares about Trump or interest rates or anything like that. That's just stuff that's happening within one sector, which is pretty exciting.
Yeah, so maybe that's the point to end on, is that share prices follow earnings. So if we see earnings next year, then share prices will be fine.
Brilliant. Thank you, everyone, for joining us through 2025. And we're looking forward to being back on the call in 2026 and helping, supporting, advising, guiding, engaging with all of our clients and advisors across the country. So we very, very much value working with you all, and look forward to a positive new year, and wish you all a fantastic Christmas period and summer break for those of you who are having it.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.